next video, continuing forward with the accounting cycle, we're going to be talking about, very briefly, financial statements and ownership structure. So depending on the way you have structured the business will depend on what the equity section on your balance sheet will actually reflect. So for example, if you're a proprietorship or a partnership, then in your equity section on the balance sheet you would have accounts such as owner's capital or John Doe's capital, Jane Doe's capital. You would also have a drawing or withdrawals account for each of the owners. In a corporation, you could have preferred stock, common stock, paid-in capital in excess of par, and retained earnings. So let's talk for just a second about paid-in capital in excess of par. That is when your stock is issued above the par value. Anything above the par value would be included in this paid-in capital in excess of par account. And now we'll talk a little bit about retained earnings briefly. So again, retained earnings would appear in the stockholders' equity section of your balance sheet. And following through the prior discussion that we've had, retained earnings is equal to your beginning retained earnings plus any net income or less a net loss, which will be your revenues less your expenses from the income statement, less your dividends that are paid out. That would give you the ending retained earnings amount that would then appear on the stockholders' equity section on the balance sheet.